Caffeinated and ready for our next panel, which is on the outlook for fixed income. And I'm very, very pleased to be joined by Gurpreet Gill, macro strategist, global fixed income at Goldman Sachs Asset Management, April Larousse, head of investment specialists at Insight Investment, and Bruno Duarte, financial credit portfolio manager at Algebris Investments. So we've heard in the macro panel, and to extent in the equities panel too, about a sort of quite mixed outlook, and indeed there's been some mention of a pretty torrid time for some parts of the bond market as well. So we're going to attempt to challenge some of that view today. So I'm going to start by asking each of you, in a similar vein to previous panels, what do you think will be the biggest theme in fixed income for 2024? Perhaps Gurpreet, we'll start with you, then go to April.
Yeah, sure. So the biggest theme for us is that bonds are back. No, really, because I know we made that same declaration this time last year, but if anything, we do think that the case for bonds has strengthened entering next year. If we just take a step back, in 2022, we had rapid inflation, rapid tightening, broad-based weakness. In 2023, we had a slower pace of inflation and therefore a slower pace of monetary tightening. But we, of course, had a rise in long-term bond yields this summer that reflected a confluence of factors, higher than expected supply, recalibration of thoughts on the fiscal outlook, but also on a positive side, reduced expectations for recessions. And so even though this great escape from a low-yield world has been bumpy, we do still think that 2024 calls for a more balanced portfolio allocation, a restored allocation to core fixed income. Yields are higher. That creates protection against any future rate rises. You've got attractive income and total return potential. Another key thing is that for the first time in a couple of years, rate cuts look more likely than rate hikes. Chair Powell confirmed that at the conference last night. And then if we do believe that we're moving from a world from policy and rate shocks and inflation shocks to one of downside growth shocks, then you should start to see the negative correlation between bonds and risk assets return to negative, stay stable there, and that just, again, reinforces the portfolio value of bonds. So truly, bonds are back.
April, are they truly back?
Gosh, how do I follow that? Well, 2024, yes. I guess we're slightly a little bit more concerned about the growth outlook. Interest rates mattered when they came down, and they will matter again when they've gone up. So this idea that you will have a growth slowdown with no pain is just, fiction or wishful thinking. I think the issue with big parts of the bond market is, as Gurpreet was saying, you've had the pain, right? You had an awful 2022. 2023 was like, pretty decent. But 2024 is going to be growth a little slower, inflation a little lower, and central banks cutting interest rates because they want to get from very tight to more neutral. But neutral isn't 200 basis points lower. So we are going to have continued ups and downs in bond markets, and that will give a good opportunity to get in. We do think you're going to see a contraction in growth. You're already pretty much seeing it in Europe. Might get away with just close to zero in the US, but that doesn't mean you're going to have a massive default cycle. So you look at fixed income, and I was looking at, sterling corporate bonds. You can look at global IG markets, and you're sort of 5.5%, 6%. That's going to lead to asset allocation shifts. And so as much as I love equities, bonds look really interesting. And if you do the math, you can have a really big rise in yields about 90 basis points further without losing any money, because you've got a lot of protection. You've got a lot of fat built into the bond yield now. So as long as you can find a manager who can avoid defaults, it's silly not to have more bonds. So I suppose 2024 is about, frankly, a bit more misery when it comes to growth. But bonds love misery. So that's a pretty reasonable environment for us.
We'll come back to defaults in a moment. But Bruno, you obviously focus on bank credit, so providing a slightly different perspective here. What are your most sort of prominent themes for the sector next year?
Yeah, it's actually a very good word that April just used, miserable, because when you look at the bank sector, it's always a sector that is stuck in permanent misery. And there's an interesting stat that just keeps on coming across, which is 89% of investors actually think there's going to be a serious banking crisis the next 3 years. And I think it's just interesting that everyone is just naturally bearish on a sector that from 15 years of the global financial crisis to today, it's night and day. Everything has changed. whether it's capitalization, asset quality, profitability. We have to remember that in 2008, the sector was not fit for purpose. And what I mean by that is across Europe and the UK, 85% of all credit creation has to come from the banking sector. In 2008, there was no capital that could underpin credit creation, which is why governments all had to step in the UK, all bar one bank toppled over. Where we are today and what we saw with COVID was precisely the opposite. When COVID came and everyone was convinced that the banking sector was going to have a repeat of 2008, everyone was stumped. Everyone thought, well, how is asset quality even better 24 months after COVID than it was going into COVID? This makes zero sense to me. And if you look at to last Friday, NFPs in the United States, no one had 199 and a drop in unemployment on their bingo cards. Everyone was thinking NFPs would be 100 or 150, and they thought unemployment was going to be 4. The Fed last night in its revision of notes actually told you they think unemployment is going to be at 4.1 within 2-3 years' time. So if you are the banking sector, and the biggest risk for you is actually a rise in unemployment, but what we saw with COVID was precisely the opposite. Governments, regulators don't want social fabric to get ripped up. And what they want to ensure is that everyone remains in an employed situation. If you're employed, it means you continue servicing your loan. And if you service your loan, the banks technically don't have any issues going forward. So what you have is a sector that continues to generate 200, 300 basis points of excess capital every year and doesn't know what to do with it. So when you look at some of the bonds out there by the banking sector, to what April was saying, you're looking at, in many cases, unlevered returns in the low teens. And if you think that a bond has 1/3, 1/4 the volatility of equity, then that means you need equities to go up 50% for you to be indifferent between owning a bank bond and owning a bank equity.
That's a pretty sort of optimistic outlook for the asset class. But as we've heard in other panels, and indeed just in the conversations and networking, next year does look set to be quite tough for some companies. So we've talked about higher for longer rates, so the Fed has maybe dispelled some of that last night, a kind of big swings in growth, and we're going to see a surge of debt maturities in the coming years as well. So April, perhaps starting with you, how well are companies positioned to cope with these higher funding costs? And I think, crucially, are we going to see sort of significant divergence in corporate bond performance over the coming year?
Companies are actually going into a difficult time pretty well equipped. So I guess you would say that, it's never nice to have economic slowdown, but if you go in having been quite sensible about leverage, so when things were great in 2021, companies reduced the amount of debt they had. And that was whether it's a high yield business or an investment grade. So that was great. That was smart. They also, of course, issued the longest bonds they could get away with. Again, smart. So when we look at things like how are coupons going up, because all new bonds are more expensive than old bonds, what we see is it's probably going to take a couple of years to really feel it. So yes, the average coupon a company is paying has gone up a little bit, but it's, on a graph, you barely see it. So that will come. And there are definitely some businesses, probably in the high yield space, who maybe just never really made any money. And when bonds were cheap and they could get practically zero cost financing, they could kind of creep along. And I know the media likes to call them zombie companies. Those businesses may not make it. But when we're looking at the sort of wide spectrum of investment grade, as well as plenty of companies in the high yield space, we're like, they will survive. It won't be great, but they will survive. And luckily, bond markets are priced for, frankly, not a great economic growth outcome. So we're not looking at massive amounts of optimism in the bond market and thinking, they've got a rude awakening coming. I'll do one last quote because I read it this morning and I liked it. There's no such thing as a bad bond, just a bad price. And the average price of an investment-grade corporate bond is 86. So if you think it's going to mature at 100, then it's a pretty reasonable entry point.
Gabrielle, you've talked about the importance of considering the cyclical with the secular, especially in the high yield space. Is that something we should be looking out for next year too?
Yeah, definitely. I think just to extend on some of the points that April was talking through, we also have been fixated on what is the impact of higher funding costs for companies. We did some conservative stress analysis of over 1,500 companies in the US and Europe. We're looking at what would it mean if they had to refinance all outstanding debt at current rates, which companies, which sectors are most exposed. And I think some of the key conclusions echo what was just said, which is that in aggregate, this transition to a higher rate regime is manageable. Many companies locked in low rates at long maturities, but there are going to be pockets of vulnerabilities. And when I talk about the dark side of higher rates, one of the things to be mindful of is capital structures where they have floating rate debt. They face a swifter transition to higher interest expenses. And in the high yield market, like you mentioned, you've also got to navigate structural shifts from the way that we work, remote work, that's creating issues in the commercial real estate sector. There's a lot of streaming competition that's creating challenges in the media and telecommunications sector. In the way that we shop, you've also seen we've already had a bit of a default cycle prior to the pandemic in the retail space around that. So you really have to balance those structural shifts with the cyclical dynamics, because a lot of those structural trends, they are going to stick around even if you have a soft landing, hard landing, or no landing. And so this really underscores the importance of bottom-up bond selection. So I think in the last cycle you had liquidity to lift all boats. That's not the case going forward. So even though there is a bright side to higher rates, higher income, higher total return potential for more efficient capital allocation, perhaps even some greater financial discipline, you've also got to navigate the dark side.
I think just turning back to banks for a moment, Bruno, you've talked a little bit about your outlook, but of course not all banks are sitting in the same situation. I think, for example, you're much more pro-Europe at the moment.
Yeah.
Could you tell us a bit more about that?
No, absolutely. So I think there's several reasons why we actually take comfort from the European and the UK banking landscape. First of all, there's annual stress tests that get done by the Bank of England and the ECB as well. And these are very stringent tests that get basically published, and so anyone can go through and have a look at them. The second thing as well that we saw was that everyone was shocked with what happened with Silicon Valley Bank and First Republic in the US. And again, the muscle memory just says, well, it's going to happen on European shores. But when you actually think of what actually happened within Silicon Valley, Europe had at Silicon Valley about 10 years ago is the Greek banking system. The Greek banks were doing this massive carry trade at the time. They all got wiped out when someone decided to do a referendum vote. And from that day forward, the ECB effectively banned banks from doing the carry trades that US banks were continuing to doing. The First Republic kind of high net worth individual deposit flight that we saw take place very quickly happened in Banco Popular in Spain about 7 years ago as well. So what we're trying to say is what happened in the US that everyone was fearing would happen here in Europe, well, we've already got the tattoo and the t-shirt to prove it, and the regulators have adjusted to it. What's really scary about the US banking system is that they've got over 4,000 banks, and only the top 12 are held to the same accounting standards and regulatory standards as pretty much everyone in Europe. So there's a lot of catch-up that the US banks have to do in relation to Europe. So when you put it all together, where we take another leg to really make sure we're comfortable with it is we've gone back 25 years of data, and we've basically said, okay, what happened in the TMT burst of the late 90s, early 2000s? What happened with the global financial crisis in 2008? What happened with the European sovereign debt crisis, taper tantrum, COVID, etc.? And the conclusion we reach is for the main European banks that make up the bulk of our portfolios, we would need to see losses 3 to 4 times worse than at any time in the last 25 years for a European bank today to get back into dire straits it had at the global financial crisis. So what we're trying to say is the regulators across the UK and Europe have effectively bulletproofed the banking system today. And that's why we think they're in a much better situation to cope with anything gets thrown at it. When you saw deposit flight taking place in the US, the system just here is more than apt to cope with it. And we really didn't see it materialize. So that's why overall we think sticking to European banks, sticking to UK banks, we think it's a really good sweet spot, and it's something that we effectively concentrate our funds on.
Bruno's already stolen my stat around the 89% of investors
Sorry.
that predict another banking crisis. But we've talked about sort of headwinds for the sector as well. And April, I think you've noted that there are pockets of the US where perhaps we need to be a little bit more wary on banks, despite being sort of overall constructive on the sector.
Yeah, I mean, obviously the regional banks are the big lenders into the commercial real estate market, and we all know this, and we need the local banks to be doing that. But, there are issues around obsolescence, right? I mean, I don't know about you guys, but we don't have to, not everyone's in all the time. So of course, you can't just change your lease, overnight. Maybe your lease goes 3 or 4 years, but ultimately companies are saying, I don't know if I need 200 desks, maybe I need 150. So, those trends will obviously lead to some buildings just not being necessary, especially ones that are expensive or not in great locations. But that doesn't mean every business office is obsolete. So we're kind of going through a period where we're looking at banks generally and saying, okay, what are the longer term trends for some of the lending they've done? We actually think that the banking crisis, as we were just talking about, Bruno was mentioning earlier this year, wasn't really a crisis because the largest banks got even larger, right? Everybody just ran to Wells Fargo. So that wasn't really a crisis. And of course, any bank is systemic, right? I mean, Silicon Valley Bank, Signature Bank, they weren't very big, but my goodness, the Fed was terrified, right? And of course, UBS and Credit Suisse were forced into a marriage. So the whole, when we're looking at any sector, we're saying there's some really great companies, and the largest banks, fabulous. Really, even the largest regional banks, they're only a teeny bit smaller than the 12 largest banks that Bruno mentioned. So there's some real value there. They're not doing a lot in the commercial real estate space. But there will be some banks that are, perhaps a few years down the line going to be looking at loans that they probably wish they hadn't made. So it's kind of like a very slow motion, I don't want to say car crash because that's like a contradiction in terms, but there will be some areas where the lending, in retrospect, looks like not a great idea. But that doesn't mean that we write off a sector. We look for areas that are attractive.
I suppose what I'm hearing here is sort of household names are the place to focus, but obviously even those are not immune from kind of longer term consumer trends that are affecting how we look after and move our money. I mean, Gertrude, do you think that is something that the sector needs to be aware of?
Yeah, definitely. It comes back to this intersection of where we are in the cycle with structural shifts. And so one of the things that we know that is impacting the banking system is that you can now move your money around the banking system at the tap of an app. And so there is greater competition for deposits. Deposits face competition from higher interest rates in the bond market too, to just plug the fact that bonds really are back again. But that's one thing to navigate in the banking system. To just, I think, build on some of the earlier comments though, we are actually constructive on bonds issued by US banks. That is the larger banks. The larger banks make up a larger proportion of the US investment grade dollar denominated market. And we've seen that bonds there had a spread premium attached to them in 2022 because there was more supply than anticipated. Then you had the regional bank crisis, and of course the market will paint all banks with the same brush. And so there's actually a very attractive risk premium there to capture. You've got wide spreads for banks that have got good liquidity and capital positions, and we do focus on those banks that have got good scale. Diversified deposit bases is critical. We learnt that earlier this year. Diversified business models, and also ample access to different funding sources.
Brilliant. Well, I'm going to pivot slightly now to something completely different. In the equities panel, we heard that investors place more trust in information and data that they analyse themselves as opposed to that which is intermediated or editorialised. An example of which would be ratings and research from credit rating agencies. I mean, again, back to banks, but Moody's cut its view on big US banks back in November, or at least some of them, and I think just last week did a similar cut its outlook for 8 Chinese banks based on potential credit quality decline. Bruno, more in the round and not specific to any particular market, I'm just interested how ratings agencies inform your investment process.
Yeah, well, I mean, the funny thing is they're actually upgrading European and UK banks.
There you go, okay.
So I guess that reinforces the view away from the US and into Europe. Look, I think rating agencies have a kind of a tough spot, a tough business, because if you look at when they assess the bank, because of the rules and the structures of how things have changed today versus how they were in the past, it's always about ensuring that you don't pick the one that goes down, because that's the worst thing that could happen to them, is actually have an investment grade rating on a bank that could actually get into trouble. So they're just naturally fearful, and I think the way the fear manifests itself is they get too overzealous with how they notch some of the capital instruments, and there's some notching that is applied And the advantage of doing that is for investors and portfolio managers like ourselves, it creates this anomaly. There's like rating arbitrage that you could take advantage of. So for example, if I were to tell you that, BNP's AT1s are notched almost as junk because the rating agencies in their infinite wisdom believe BNP could actually not pay a coupon, extend on the bond, and actually, write out the whole principle when BNP in its entire life has never done anything like that. BNP continues to generate excess capital. But the rating agency, just for the fear of getting it wrong on a deeply subordinate instrument, decides to basically protect itself by notching 3-4 below the overall senior rating. That is a great opportunity for us. So we do take on board what they do, but we had predicted and we had been discussing with investors almost 18 months ago that, mark our words, rating agencies are going to start upgrading European banks. And everyone actually thought we needed to go get our heads checked. And the reality is it's starting to come through. The beast of all beasts, Deutsche Bank got upgraded on Friday. I mean, this is Deutsche Bank, who everybody always has the muscle memory that if something goes wrong in Europe, it's got to be with Deutsche Bank. And even they're getting upgraded. So I think even the rating agencies have realized, okay, have we actually got this wrong here? Has the banking system really changed, or is it like it was in the past? And I think they're slowly coming away around to our way of thinking. And I think we're just going to see more upgrades coming through. So US, I think, has just caught Gurpreet in just the kind of like the crosshairs of what's going on and the regulation, the changes, the uncertainty. Europe has gone through it. And I think it's definitely emerging on the other side of the tunnel. And, for us, it's a better risk-reward investment. And it's just a safer place to look at the moment.
I mean, you hit there on one word, which I think must be on a fixed income bingo card for this year, which is AT1.
Yes.
So I think my next question was going to be around sort of a particular element of the fixed income universe, a subsector where you're particularly excited. I mean, would AT1s be up there for you?
Look, AT1s for us are effectively our bread and butter. And the reason is, if you look at the history of Algebris and how it started off as a long-short equity fund right before the global financial crisis. And just like the Fed pivoted last night, Algebris and the global financial crisis pivoted from equity into credit. And what we realized was that these deeply subordinated instruments were actually quite interesting if you're comfortable with the equity investment case of a bank. And what we do and what we've always done is we just stick to banks. Even within the main fund we run, it's just a bond fund. It doesn't have any side bets in equities or indices or futures or anything. It just literally just actively selects bonds of European, UK, and other global banks. And when we look at AT1s today, like the fundamentals have never been better, as we discussed. The technicals are interesting because the banks have issued all the AT1s they need to issue now. So now it's just a net issuance phenomenon. And then we just look at the technicals and the valuations. You can pick 400, 500 basis points of a national sovereign champion. BNP will pay you 7.5%, or you can earn 2.5% to 3% by a French out. What would you rather have? I mean, I think in this kind of fight for duration, inflation's overcome, rates are starting to rally. Everyone, I think, parked their money in money market funds in the last 12 months, 18 months because they were paying you 5-6%. Well, you're probably not going to be enjoying that for very much longer. You need to find an alternative. And that alternative means if you're comfortable in deeply subordinated parts of the cap stack, like we are, then we think AT1s are probably the best investment out there across the entire fixed income world. Because again, there's this rating arbitrage that people don't realize. It always gets comped to high yield, but it's nothing like high yield. So what you get is you get double the spread that you really should, and the average AT1 is yielding you 8-9%. So it really is a very good combination. And again, you don't have to go off-piste. You can stick to national champions, which is what we do, and you get an all-in, great little portfolio to weather you through inflation of 2, 3, 4, 5%.
I think going off-piste is something we'll look at in our private markets panel a little bit later on. But we've talked a lot about investment grade and high yield, but I think there's a sort of larger discussion going on at the moment about sort of broadening out where to look in fixed income. And I'm interested in the sort of one area that you would sort of direct clients or investors to next year. I mean, I think green bonds is something you've spoken about before.
Yeah, definitely. I think, just to take a step back, our colleagues in Goldman Sachs Global Investment Research puts the price tag of what the investment needed to decarbonize 75% of the global economy at $3.1 trillion a year. And that colossal amount of investment is going to need financing, green bonds are going to be a key source of that financing. The green bond market is no longer niche, it is mainstream. It's a 2 trillion euro asset class, and it's going to grow, in our view, by a further 600 billion euros next year. And I think the easiest way for investors to think about green bonds is that they are like an electric vehicle. They take you towards your investment goals but minimize environmental impact. But like an electric vehicle purchase, you need to have astute buying selection. So you need to not only analyze the conventional risk and return characteristics that you would of a conventional bond. With green bonds, you really also need to understand the use of proceeds. So is that bond indeed financing that green building, bolstering resilience to physical climate risks, energy efficiency, whatever that might be. And so you still have to stay active and selective in the green bond market.
April, what about you?
Well, there's so many interesting things going on in fixed income at the moment. What would we point people to? You probably want some duration in your bond fund. Haven't said that in a long time. So what we are pointing clients to is, if they want to allocate to fixed income, we have a preference for investment grade because we do think the economies are slowing down and they will be more resilient, and we like that investment grade has interest rate risk built in. So that would sort of be our natural place to start, whether it's an impact bond or any other. I mean, we're going to be very pragmatic wherever you're going to get the cheapest available cash flows, to be brutal. You know, if it happens to be green, wonderful. All companies are obviously trying to improve disclosure, trying to reduce carbon, and of course that's, that will be monitored. I think, however, though, because the environment macro-wise is there's probably going to be a lot of volatility. You're still going to get unhelpful inflation numbers. You could get the odd headline from geopolitical risk. There'll be some bumps. So, be wary that although 2024 looks much more promising for investment markets, certainly fixed income markets, we're very aware that you could have, shall we say, buying opportunities. So we've said to clients, listen, this is a good moment to allocate, but, know that it may not be a clear. If everything was clear without any risk, you wouldn't get any yield, right? This is the time to be bold, but also to accept that there will be some volatility.
One of the elements that was touched on at the end of the equities panel was there are opportunities in emerging markets at the moment, obviously very sort of active security selection, but there's a big World Bank report out yesterday that showed that high funding costs are pushing quite a lot of developing markets into sort of severe default risk, and they're at crisis levels. But so I'm worried if you're sort of worried about that, or if there are other pockets of emerging markets, perhaps in the credit sector, where you do see opportunities. Anyone?
I can take that. Look, in the EM sovereign space, we see it as there being a cohort that is vulnerable. There's some EM sovereigns that are resilient to higher funding costs, and that there are some that are opportunistic. So you are starting to see avenues for renegotiation with the IMF. That would lead to some upside potential there. But the EM asset class is heterogeneous. Of course, you need to be selective. But one of the brightest spots for us in the EM space is emerging market corporate bonds. So that asset class provides a very attractive yield premium over comparable quality developed market peers. And we don't necessarily think that reflects weaker fundamentals. Rather, we think it reflects the fact that that market is under-researched, it's also under-invested. And so as an active manager, you've got more alpha opportunities to exploit. And so we think it's also worth bearing in mind that the asset class is somewhat a market of survivors. You've got EM companies that have withstood the shocks that you've seen over recent years, and that didn't just start with the pandemic. You also had the 2015 oil price shock, which many of these companies have lived through, and EM companies are used to steering through volatile macro waters. And so a lot of the macro headwinds that we talk about, they are well accustomed to that. And so as an investor, you can get exposure to everything from a recession-resistant food and beverage company that's benefiting from a growing middle class, to Indian renewables, which we're constructive on, which are helping to advance the energy transition. So it's definitely a very opportunistic asset class. And the way to think about it from a portfolio construction perspective is we talk to clients about diversifying your existing corporate bond exposures if it's investment grade. On that note, the EM corporate bond market is investment grade rated on average. or you diversify any existing EM sovereign bond exposure to include EM corporate bonds.
I'm conscious of time, and if there are any questions from our audience, I think we'll go to them now.
Thanks. So I just wanted to pick up on something that I think it was April said around, how bonds are priced at the current moment, and feeling that actually it's relatively attractive how it's priced. And I understand it's great to pick up a couple of 100 basis points from the risk-free, but if you just look at spread levels, do you feel that a reasonably heavy credit cycle is priced into where spreads are today?
Yeah, we basically have a soft landing priced in, which I guess might be different from other risk markets, which I think maybe are thinking no landing. We look at credit spreads, and we look back at 20 years of data and 10 years of data on a percentile basis. And if you look at something like investment grade, you're around 75th percentile. So 25% of the time, credit spreads have traded at cheaper levels. That's pretty reasonable. I mean, that's, it's not pricing Armageddon, and nor should it, because actually, as we all talked about, everyone has a job, right? So, the economies are still in reasonable shape now. But it's certainly, the bond markets are not completely thinking nothing to see here. There is definitely some economic risk priced into spreads. So, that makes us think, okay, actually, spreads are not as attractive as they were when Silicon Valley Bank was taking headlines, nor are they complacent, thinking everything is fine, which leads us to have a small, long credit position in investment grade. But we're always looking at percentiles and ratios relative to history, because you do your fundamental analysis, and then you say, okay, but is it cheap enough? And the answer is, it's a little cheap, on a spread basis. The thing is, a lot of people invest on yield. And so we've got clients saying, yields are so attractive. I don't normally bother with fixed income because for about a decade there was no point. But now they're saying, I'm going to change asset allocation, which means money coming into bonds that used to be somewhere else. And that's likely to push spreads narrower.
Yeah, I'd maybe add a couple of things to that. I think on the spread point, to April's earlier point, if you'd think of the break even, so how much would spreads need to widen to offset the income potential, the yield that you now have, we don't think that widening is likely given the fundamental backdrop. And I was looking at the US labour market this week. Since May 2020, the US has added over 26 million jobs cumulatively. That far exceeds the 20 million in the last cycle, which was one of the longest expansions on history. So that just tells you how firm the labour market fundamentals still are. And I think the second thing to keep in mind is just the composition of indices and markets and how that's changed. So the high yield market, for example, is higher quality today than it has been in the past. And so you can still do a lot of this last 10-year percentile analysis, but also factor in any changes in the composition of the market.
Any other questions from the floor? The one at the back, I think.
Hi. I think there's been a lot of discussion recently about gilt supply vastly exceeding demand in the coming years, especially as the BOE starts to sell off through QT. I was just wondering if you had any thoughts on that, who's going to be buying that debt?
Age of net sellers in the UK, perhaps.
Very, very topical. Insight has a lot of gilts because of our LDI business. It's an interesting question. I think all the government bond markets are asking themselves the same question, or perhaps those people who issue the government bonds and the various agencies, who is going to buy them? Well, in the gilts, we're seeing banks buy them, we're seeing international investors buying them, and frankly, even if you talk to a bunch of fund managers, they're buying them personally. So I guess at every yield and price point, a buyer will be found. The problem is, how cheap do government bonds need to get to attract capital? It is going to be tricky, and my comments about markets might still be quite volatile will be in and around, gosh, there's a lot of government debt. How will they get it all away? Ultimately, I'm a sort of believer that should markets become disorderly, a solution will be found. And, we have seen that central banks don't really tolerate very disorderly government bond markets. They come in and use all sorts of perhaps unconventional tools to calm things down. Now, that's not saying we expect them to start buying government bonds again, but they have scope to reduce the amount that they're selling, potentially, or selling, shorter bonds. Or they could change the scope of the unwinding program, because, of course, they have a lot of debt that needs to be refinanced. And so that is something that I think will continue to cause people a certain amount of consternation. How do you actually finance over 100% debt to GDP? Well, Japan's done it for years, so we do have some precedent here. But I don't think anyone would look at Japan's economic experience for the past couple of decades and think we want that. So.
Yeah, I would just add that is one of the key top-of-mind things for 2024 is the interaction of fiscal positions and QT. And I think on the fiscal front, there's 3 ways that governments can be addressing this. They can run better fiscal balances. That seems unlikely in this political climate. You could inflate away debt. That doesn't seem likely now that central banks are committed to inflation targeting and inflation is coming down. Or you could have a miraculous uplift in potential growth thanks to advances in generative AI and so forth. But again, that doesn't seem likely, at least in the next 2 to 3 years. And so all of this does point to upward pressure on longer dated bond yields. It's one of the reasons why we are positioned for yield curves to steepen in the US and in Europe. And when you're thinking about the marginal buyer, in the US at least, household or retail investor participation in the bond market is very low, and so that is a potential growth areas. You could see a demand pick up from there, but it's definitely something to keep watching. And I think that the key unknown question is where yields have to settle to entice that demand.
In the back.
We read a little bit about the rise of fixed income ETFs and contractual active managers, but whether you think we'll see a kind of ETFization of the fixed income market and whether that's a concern.
I can start with that. So a fixed income AT1 ETF this year had Credit Suisse AT1 bonds. Algebris did not. So that fixed income AT1 lost for their holders 7%, 8%, because that was the weight of CS within the AT1 index. So I think when you think of active versus passive, I think that's your biggest triumph as to why the passive structure of an ETF, yes, it's cheaper. Maybe for corporate debt it's different, but then you see stories like Cigna. So I think what you find is that there's always something lurking somewhere. And I think maybe because it's the competition of the cheaper product to produce and no one wants to pay that fee. But the reality is, I think, in this day and age of what bonds are doing, you need to know what you have in your portfolio. And I think Credit Suisse was the case in point that it made or break your year. I mean, across the AT1 space, if I were to tell you that Algebris had inflows every week after Credit Suisse, and that the fund is up 10%, and if I also told you 15% of the AT1 market got wiped out in one weekend, you'd think that this is some Hollywood movie, and it's not. That is what active management can do for you if you entrust investors and fund managers with your savings.
And they read the small print.
And they read
the small.
I'd also say it depends on the market. Like if it's a liquid market, it's very different where you can have smart beta approaches to constructing ETFs, and ultimately we are trying to get our clients exposure to the right asset class that can achieve their investment goals. And the vehicle for doing that can be a mutual fund, it can be an exchange traded fund, it can be a separately managed portfolio. So there are definitely growing opportunities in the ETF space. It depends on the asset class. It depends if you want to approach it by having some rules-based approach to constructing that ETF to begin with.
Any further questions? Yep.
conscious there are a lot of elections coming up next year. More than half of the world's population are going to the polls. Just wondering how this impacts your investment outlook and what you would be recommending to investors given the volatility that will arise undoubtedly as a result of that.
Okay. We were just talking about the UK election, actually, and what could happen. And financial markets appear to be indifferent between whether it's a Labour-led government or a Conservative-led government. So there doesn't appear to be implications for massive changes in policy, economic policy, under, let's assume that Labour start running the UK. I think the UK election is much more, or US election for me is much more terrifying, actually, because you can imagine an enormous change in the US's approach to many things under a, shall we say, Trump presidency than under whoever will be the Democratic nominee. Probably Joe Biden would, but they're very, very different. So is that a good thing or a bad thing? So difficult. And even before Trump was elected the first time, markets didn't know what to do with that information. Would he be good for risk markets or bad? I think it's very difficult for people like us to, without being geopolitical experts, and even if they were, to say, oh, markets are going to do this on this news or that on that news. I think just be aware that there will be opportunities. Markets are bound to get completely scared about one headline or another, and that will be an opportunity for active management to be able to identify, cheap assets. But yeah, there's going to be more political noise, and I think the geopolitical, the wars are really problematic, right? I mean, if I'm using the most understated word ever, they have potential for all sorts of rather nerve-wracking headlines as well. So you put those two things together, and it probably means 2024 is going to be, quite an interesting year, but for the potentially not a relaxing year for the investors.
On that note, I think we're at time, so I'm going to thank my panellists very much indeed for their conversation, and please join me.